Gold has done well through history, at least in my reading of history, but also in my life, which is long enough it's becoming history, that I've seen that gold does very, very well when investors and savers are concerned about the maintenance of their purchasing power in fiat instruments. If you believe the US government statistics, I'm a voter, I don't, they will tell you that the destruction of your purchasing power in US dollars is 2.6% compounded a year.
Gold has long been regarded as a haven for wealth preservation, with its price often reaching new all-time highs during economic or sociopolitical turmoil as investors seek stability. The 21st century has been marked by numerous episodes of uncertainty, which have driven gold to record-breaking levels as market participants flock to its perceived security. Each time the price of gold rises, speculation mounts about even higher future highs. In the past year alone, gold has reached new all-time highs multiple times. RickRule, a legendary figure in mining investment, shared his valuable insights into the current gold and silver market. He highlighted that throughout history, and in his extensive experience, gold has proven to be a strong performer, mainly when investors and savers are focused on protecting their purchasing power against fiat currencies. While some economists, such as John Williams from Shadow Stats, claim U.S. inflation is closer to 12%, Rick takes a more moderate stance, estimating a compounded annual decline of 7.5% in the dollar's purchasing power. The bullish outlook for silver comes amid its ongoing struggle to outperform gold. This week, the gold-silver ratio reached a one-year high, testing long-term resistance at 92 points. While the ratio has since fallen from its peak, it remains relatively high at 89.58 points. According to one research firm, despite silver's current difficulty in stepping out of gold's shadow, rising industrial demand and dwindling supplies are expected to help the precious metal thrive on its own. RickRule notes that bull markets for precious metals are generally led by gold. The first wave of buyers is often motivated by fear, but generalist investors enter the precious metals market as the narrative grows. At this point, leadership shifts from gold to silver. We're about to explore the video, but first subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Push back on all-time highs. All-time highs in nominal value.
Yes.
And the difference between nominal value and purchasing power is what gold's all about. When people talk about $2,700 in a nominal value, they're talking about a floating abstraction for the denominator. And that's not right. I think it's really important to recognize that. Gold has done well through history, at least in my reading of history, but also in my life, which is long enough it's becoming history, that I've seen that gold does very, very well when investors and savers are concerned about the maintenance of their purchasing power in fiat instruments. If you believe the US government statistics, they will tell you that the destruction of your purchasing power in US dollars is 2.6% compounded a year. If there's any Americans in the audience, aside from me, if you look back at the basket of goods and services that you've consumed in the period 2020 to 2025, this 2.6 number is fiction. I would suggest that the CPI is the CPI. Look at your health insurance, look at your health costs, look at your rent if you rent, look at your mortgage, look at your gasoline prices, look at your grocery prices, and tell me that the purchasing power of your currency has only declined by 2.6% compounded. I'm no economist, but this is laughable. It's really, truly stupid. If John Williams were here, Shadow Stats, he'd say that US inflation is 12% compounded. I'm not going to be that aggressive. I'm going to be a moderate for the first time in my life and say that inflation, the destruction of the purchasing power of the US dollar is sort of 7.5% compounded. That's bad enough. But if you're concerned about the deterioration of your purchasing power, you have to put in one more piece of math. The predominant savings product in the United States, the predominant savings product in the world is the US 10-year Treasury. That pays you 4.5%. So if you're earning 4.5 in a currency where your purchasing power is declining by 7.5, you are guaranteed to lose 3% of your purchasing power a year compounded for 10 years. Think about that. You give the US government your money for 10 years and they absolutely solemnly swear to give you 35 or 36% less purchasing power after 10 years. The first of their promises, by the way, in my life that I believe. And that's why I think gold is going to do well, right there. Precious metals bull markets are led by gold. The first buyer is a fear buyer. I get that one. At some point in time, when the narrative achieves enough currency with generalist investors that the generalist money comes in the precious metal space, leadership changes from gold to silver. I've been trying to figure out for 50 years why, and I don't know. So I'll just say I don't know. I don't know why, I just know that. And when that transition happens, silver moves much faster than gold. And the last asset class in the continuum is the silver stocks. There's a small enough market cap of the high quality stocks that 3 times in my career, when the generalist money comes in the space, the silo, the combined market capitalizations of the silver stocks, can't handle the money that comes in. Now, the Canadian dealer network fixes that after 3 or 4 years. They print more phony certificates than anybody could possibly buy. But at the beginning of that, I mean, you see moves like Silver Standard, 78 cents to 45 bucks. Pan American Silver, 50 cents to 45 bucks. When I was a kid, Coeur d'Alene, 10 cents to 65 bucks. It's truly spectacular. Ask her why, and just ask me to give you an old man's reflection on what.
Regarding gold supply, the world's top 5 gold producers are China, Australia, Russia, Canada, and the US. However, the consensus within the gold market is that major miners have not invested enough in gold exploration in recent years. As a result, gold mine production dropped from around 3,200 to 3,300 metric tons annually between 2018 and 2020 to approximately 3,000 to 3,100 metric tons between 2021 and 2023. On the demand side, China and India are the largest buyers of physical gold, often competing for the title of the world's biggest gold consumer. RickRule also points out that precious metals and related securities currently represent less than 0.5% of all savings and investment assets in the United States. While he doesn't offer a specific gold price target, Rick believes that if an asset class with limited supply were to increase its market share from 0.5% to 2%, it could trigger significant price movements. Let's shift our focus to a video.
The disconnect in the move between the metal and the miners is easy to explain. The metal has moved because central banks have been buying the metal, and the central banks don't buy mining stocks. They're related markets, but they're not the same markets. You know, I'm looking out here, and I was looking around for any central bankers, and it seems they're missing. So the idea that there's 2 different buyers classes in a related asset class explains most of the difference. The rest of the answer is not so pretty, frankly. If you dial the precious metals equities market back to the year 2000, in the period 2000 to 2010, the gold price increased 7-fold, and the free cash flow per share of the major miners decreased. It took real skill to turn a 7-fold increase in the selling price of your product into reduced free cash flow per share. Industry investors and generalist investors, let's just say they've had low expectations around the efficiency of the mining industry. I believe that investors, at least for the next 2 or 3 years, will hold the industry into account. The third circumstance is that as the gold price increased, the price of inputs, or the cost of inputs increased too, so that the margin expansion that some investors expected the gold industry to show in the last 3 years didn't occur. Maria and I have the advantage of having been around a while, and we understand. And just looking very recently at the quarters that you saw at Lundin Gold, Alamos, Agnico Eagle, what you're starting to see just now is gold companies that aren't beating their quarterly forecasts. They're murdering them. They're clobbering them. In other words, to say, I think that's going to follow. But I want also to answer your previous question. The math that's important to me around future participation in this market is that the market share in the United States of precious metals and precious metals related securities relative to other savings and investment classes is less than 0.5%. JP Morgan Chase suggests that precious metals and precious metals related securities comprise less than 0.5% of all savings and investment assets in the United States. This is very important because they estimate that the 40-year mean market share was 2%. So gold doesn't have to, all these gold bug things, gold doesn't have to win the war against the US dollar. Gold doesn't have to supplant the US 10-year treasury. All it has to do is revert to mean. If the market share reverts to mean, demand for this asset class, precious metals and precious metal securities, increases 4-fold in a market that right now is 23% of the world's savings and investment assets. That's all it has to do. That's precisely what it's going to do. I can't give you a gold price target because I'm not that smart. All I can try to say is that if an asset class where you can't increase supply very much goes from a 0.5% market share to a 2% market share, it has the potential to do absurd things to price.
Economic expansion is key in driving gold prices, as it boosts demand across various sectors, including jewelry, technology, and investment. According to the World Gold Council, this is especially evident in developing economies, where gold is valued both as a luxury item and a means of preserving wealth. Additionally, market risk serves as a significant catalyst for gold's value, with investors viewing the precious metal as the ultimate safe haven asset, a hedge against currency depreciation, inflation, and other systemic risks. What's next for the gold price is never an easy call to make. What is your stance? Your opinion matters. Drop your thoughts in the comments, hit the like button if you enjoyed this, and subscribe to stay informed on our journey together.